Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion we will be talking about futures spread trading. This is the simple concept of looking to go long and short at the same time. And while we're pointing down, please click that like and subscribe button down below because it allows me to keep coming out with information for you guys. But without further ado, let's cover what we're going to talk about, and that is exactly how future spread trading works, what it is of course, as well as how strategies employ the concept of futures spread trading. It is, after all, considered to be one of the safest forms of arbitrage trading that exists today, and as such, it could be something very useful for those of you looking to pass the gauntlet mini. So without further ado, let's dive on into that material and learn about futures spread trading. Futures spread trading is considered to be one of the safest commodities trading strategies that exists out there for the futures market. It is a very valuable tool when understood and implemented correctly because it allows you to go both directions in the market. And if you're going both directions, you can't lose, right? Well, not entirely, but the idea is still a very valuable one indeed. But first, what is a future spread? And a future spread is a trading technique that the trader is going to open a long and a short at the same time in order to take advantage of a price discrepancy, with a key word being this price discrepancy. We want to focus on that. So let's continue on with this. The idea is quite simply that we're trying to reduce the risk that we're exposed to while at the same time capitalizing on the pricing inefficiencies for one or several instruments. Spreading is applied on a variety of different asset classes, but mostly within futures trading and commodities in general. A while ago, due to the market structure, the spread trading ideas were really only available to institutional and large-scale traders, but with the development of trading as it has been over the last 10 to 15 years, we have seen that market open up to retail traders like you and I. Future spread trading strategies are always gaining popularity due to their ability to mitigate risk. Traders are always out there trying to find ways to potentially curb some of that risk without necessarily hurting some of their profits. Let us imagine how a futures spread works. The main idea of a futures spread trading strategy is to capture the difference between the price of the contract that is being sold and the price of the contract that is being bought. And usually this works when we are trading futures that have different expiration dates. So for example, a futures spread could be when we go long on soybean futures and we go short on soybean futures at the same time with different expiration dates. The buy and sell positions that a trader opens at the same time are acknowledged as a single position, which is called a unit trade. The buy and sell sides of the unit trade are usually called legs. And the goal of the trader placing the unit trade is to see the long side of the spread increase in relation to the short one. That way, the spread between the positions guarantees he captures a bigger profit, or she for that matter. Depending on the trader's preferences about the type of commodity he or she wants to offset, its stay in the exact strategy on how they want to trade it, they can choose from three different types of future spreads. We have inter-commodity future spreads, intra-commodity future spreads, and commodity product spreads. Aside from these, you also have less talked about spreads such as bull and bear future spreads. The difference between both is that in bull future spreads, the trader goes long on the near month and shorts the deferred one, while in bear future spread, he goes long on the deferred month and shorts the front month. Now, as we talk about these three ones, which are the main three, we're going to focus on inter-commodity future spreads first. An inter-commodity future spread is the type where contracts on various commodities are utilized with the same month. For example, when you simultaneously open positions to buy corn futures and sell wheat futures, both of which expire in September, this would be an example of an inter-commodity futures spread. We also have intra-commodity future spreads down here at number 2. And at intra-commodity future spreads, what we're doing is we're buying and selling the same commodity, but with different months. So, for example, a trader may buy an April soybean futures contract and sell an October soybean futures contract. In this case, the legs of the trade spread between different months rather than different instruments. This is also sometimes referred to as a calendar spread. Calendar spreads are considered easier to trade as the trader should specialize only in a single commodity because they're trading the same commodity but just doing it at different times. By learning all about the different price factors like seasonality, supply and demand, weather conditions, etc., you can focus on just one, and that's less information to digest in general, and that at least is the idea behind why the intra-commodity future spread isn't overly difficult when compared to the others. And then finally, we have the commodity product spread. And the commodity product spread reflects the difference in the commodity's price in its raw form and as a finished product. So commodity product spreads are usually used as a frequent choice by traders that are interested in, say, oil and the agricultural industry. Traders usually enjoy the type of commodity product spreads offered here and trade them by going long on the raw material and then shorting the finished product. Now, the way that they profit basically replicates the profit margin of the company that handles the whole process. And we want to bear in mind that this type of future spread is usually more of an exotic instrument, and it's not as powerful as, say, an intra-commodity future spread. Margin requirements are a crucial thing that any trader interested in future spread trading should definitely be aware of. They indicate the level of volatility and risk associated with the underlying commodity or the relationship between the traded assets if there is more than one. Futures spreads margins are usually lower than those of traditional futures contracts as they bear less volatility and hedge against systemic risk. In the case of an unexpected event like a terrorist attack or a stock market crash, a war breaking out, or a default of a country, for example, both legs of the unit trade should be affected equally. That way, the trader won't incur any losses. Let's paint this difference in some type of numerical fashion, shall we? If we were to say that Joe wanted to trade corn and wheat with a spread strategy, we could say that the margin for corn futures is set at $2,000, while the one for wheat is currently at $1,000. Instead of posting $3,000 total to trade the spread on two contracts, Joe can just simply receive a 75% margin credit. This means the initial margin will equal just $750, which is substantially less than the $3,000 we might have initially thought. What this comes to show is the massive difference in terms of the margin requirement when trading single contracts outright as opposed to trading them as a spread. Often, depending on the instrument, the futures spread margin can be as low as just 10% of the value of the margin requirement for a single contract. But before trading, it is essential to check with your brokerage service provider to determine the current margin requirements that you will need to comply with when trying to complete a futures spread. Here we have a list of some very popular spread options out there to choose from. Of course, this does not include every possible outcome or every possible spread that you could conceive of, but instead, this is just to give you an idea of how they work and show you some examples. The first is going to be, say, a July corn and a December corn futures contract. That could be a spread choice, and naturally, the degree of what kind of spread you choose to employ will vary based on these as well. We also could do something like a soybean and corn spread, or we could do a Kansas City wheat and a Chicago wheat spread. We could do a natural gas as the raw material and electricity as the finished product for another type of spread, obviously, if we're changing it between the raw and the finished form like we talked about. We could do crude oil as a raw material and petroleum products as a finished product. We could do soybean as a raw material and soybean oil as the finished product. We could do Fed funds and euro dollars, and remember, euro dollars are the American dollars held overseas. Then we have the 2-year T-note as well as the 5-year T-note. The list just goes on and on. The idea is that traders can shape their preferences depending on the type of spread that they're interested in trading, as well as the specifics of the underlying asset. This will give you the idea and the understanding in order to implement perhaps your very own spread that isn't even listed here. Depending on whatever it is that you're interested in trading, there is a good chance in the futures world that you might be able to find a way to spread it, especially if it happens to be in the commodity sector. In the end, no matter what spread you want to trade or are trading, we want to make sure that we put our primary focus on the relationship between both legs of the spread rather than the overall direction of the market. If the spread is good enough, you will be making money in downward markets as well. Even though that trading spreads is less risky than buying and selling a single futures contract, trading future spreads still requires a substantial degree of expertise and attention to detail. The first step to becoming a successful futures spread trader is to get familiar with the primary factors and characteristics of the different commodities or instruments that we are willing to trade. We have 3 of the most common listed here for you, and the first is something called seasonality. First and foremost, consider the time of year and how it may affect the price of the instruments that we are willing to trade. Whether we are buying or selling single futures contracts or trading future spreads, seasonal factors are among the detrimental ones for the instrument's price regardless of the style, so of course it is important to be aware of this. The reason is seasonality determines supply and demand. Some commodities, like natural gas for example, may be higher during the winter months, while others like crude oil may be higher during the summer months. On the other hand, a warm winter can reduce the demand for gas and heating oil, so it's important to be aware of the correlation between seasonality and whatever it is commodity that we are trading. The political situation and macroeconomic conditions are also something to make sure that we pay attention to. It is essential not to only focus on the specific characteristics of a commodity, but also to keep an eye on the macro factors that might affect our spread. This includes trade wars, embargoes, global political instabilities, interest rate policies, financial and economic crises, region-specific developments. The list goes on and on. This is crucial for all types of future spreads, but most importantly, inter-commodity and product spreads. In the case of an intra-commodity product spreads, although there would be some difference, the overall effect should be equally comparable with both legs of the trade. For example, if we were trading April and August crude oil and some instability in the Middle East arose, then the spread between the buy and sell order should remain the same. And then finally, we have stay informed about the industry. Financial and commodity markets are very dynamic. Things can change from day to day, and if you want to succeed as a futures trader, you should keep track of the news and updates regarding the industries that you are interested in. The best way to do that is by accompanying your morning coffee with an official industry analysis report. It may not sound that exciting, but it will set you on a better path to success if you are staying informed about the various industries out there. As you might imagine, there are many advantages to trading futures spreads. However, I outline my favorite 3. The first being the fact that it is a better risk-reward ratio than trading single futures contracts, and this is a very powerful one. If we have a better risk-reward ratio, it in turn makes our requirement for success that much easier to achieve because our requirement to succeed doesn't need to be as high as if we were trading with a lower risk-reward ratio. We also have the fact that price movements are easier to forecast while we are trading with a spread. Trading future spreads makes it easier to predict how the different contracts, the legs of the trade that is, will react to particular events. During both bull and bear markets, the nearer contract's price is usually more affected than the one of the longer-term contract. And finally, we have a good field for beginners to make their first step. And this really ties a lot into the number 1 here. The fact that the risk to reward ratio is so good relatively to trading single contracts It allows us to not have to be as high of a degree of a professional trader nailing trades at such a high degree of accuracy in order to be profitable. That means that it is more beginner friendly because we don't have to be as good with our speculation. Now, that does not mean necessarily that it is any easier, and there is actually more work involved in trading a spread because you are trading two trades instead of one. In theory, of course, but the idea is the requirement for success, once understood, should be easier on the beginner approach. As far as the disadvantages go, there were really only two that I thought were worth mentioning, and the first one is the fact that more trades does equal more commissions. If we're making more trades, we are paying more commissions. That is just a simple fact, and that is arguably the biggest drawback of futures spread trading. That means each trade consisting of two legs, which is buying and selling an instrument, basically doubles our trading fees. And if we don't take this into consideration, we might be unhappy when we realize that our profits aren't as high as we were initially expecting them to be because of the commissions paid. And the number two is it may lack liquidity. Often, futures spreads are less liquid than trading other instruments or even single futures contracts. This may turn out to be a problem for traders who rely on having to get in and out of a position extremely quickly. So, to sum it all up, trading future spreads is a very valuable tool to be aware of, and as such, I thought it was extremely important to bring it to you guys. It's a way that you can potentially reduce a ton of your risk without necessarily inhibiting your ability to still profit from the markets, and in some cases, it can be an even more profitable way to go about trading than what traders are already doing. Ultimately, you'll have to decide if it is right for you, and if you are interested in trading it, I wish you the best of luck, of course. And until next time, folks, please make sure you click that like and subscribe button down below if you haven't already, and I will see you soon. Cheers, folks, and happy trading.